Okay, traders. So we've gone through all the setups. We've gone through how to adjust the indicators. We've gone through all that kind of stuff. We've gone through the different patterns. We've gone through the reverse polarity signals. We've gone through all the different options that the indicators have allowed us to do and use. And I'm going to go over a couple of quick things and a couple of basics that I want you to keep in mind when looking at timing indicators versus price-based indicators. Every place that you're seeing a time signal on the chart is a time signal that is weeks old. And so one of the first things that you're always going to realize is that first your brain has to get wrapped around the mentality that every dot that you see on this chart, every single one, and every timestamp on this chart has been on the chart for a week up to 7 days prior to the actual bar closing at this time of day. So bear in mind, every one of these signals has a history, and every one of these signals was projected to be a turning point in the market over a week ago, or exactly a week ago, actually. So with every single signal that we see going all the way across our chart, we are expecting to see first and foremost a market reversal or an event. So we should see an event occur at each of the timestamps identified on your chart. The event may be a short term, it may be a long term. Each event, if we call them that, which is identified by the time of day and the bar close, each one of these events has a story to tell. And if we're looking at each of these, we can engage the market in multiple ways. Some of you listening to the sound of my voice are going to be trend traders. You're going to be using the 120 period exponential moving average to identify the direction of a prevailing trend. It's not a projected trend, it's a prevailing trend. So if the market price is above the 120 period moving average, you are going to be looking for every opportunity to go long in the market for a period of time. And by that, and based on the guidelines that we've already shown you, you should have the ability to identify what is a good signal to be engaging with. As an example, if the market, or when the market came into the signal at 309, we can see that it closed a buying bar. By closing a buying bar, it was below the average price. So this anything buying at the close of that bar was going to be a counter trend signal. With it being a counter trend signal, we would have waited until the market closed a bar above the top of the moving average. When it closed above the top of the moving average, at that point in time, let's go hard right side because this is the way we're going to see it coming. At this time of day, hard right side of our chart, the only thing that we can see is this candle. We know there's another signal coming, but it's not here yet. This is a buy signal that is below the average price. Therefore, it is a signal that we're most likely going to ignore for a period of time. We do see that the first bar after it closes a little higher, and as of this candle, we are now 3 candles in. We have now closed our first bar above the top of the moving average. By closing above the EMA, we're now looking for an opportunity to go long in the market. At this time of day, we also realize that we have some time before our next signal. So our next signal is going to come out at 336. We're not quite there, but we're getting awfully close. As we come into 336, right there, 336 is the next time signal up. So we already know when we're looking for that next reversal. Here we would be looking for an opportunity now to get into a low risk long in the market. We could either just simply buy the market at face value for the first candle crossing over the moving average because we are still within a bar or two of the timestamp, or we could wait for a pullback to the open price line. If the market gives us a pullback to the open price line, now that it has crossed over the moving average, a pullback and a touch here does give us a lower risk buy opportunity. In this case, we would have waited a couple of bars. There's the return to the open price line as identified earlier. And from that open price line, we could definitely look for a push up into the next selling opportunity. There's the market giving us a little push higher and up, target attained. We would now be flat in this position. So from that little move, again, using a little common sense, and a little looking for areas in the market to get into lower risk runs, we would wait until the market got above the EMA, came back and retested, and then all flat on that position with a 7-point move. So that position lasted from the entry until the time it was out, not a whole lot of time. At the time of day that we engaged the market here, because it was a pullback trade, as the market came and filled us at the limit order, as soon as this candle closed, we would have been able to place our risk just below the low of the candle. Again, the candle that got us into the move, we shouldn't expect the market to have to push down any further than that. So I would be looking for an exit there just below that candle because it was a pullback after the fact. The maximum risk that I would be willing to give this move would have been just below the actual candle at the timestamp. Again, everything reverts back to what happened at the time of day. Now, one of the common questions that I get, and this is just a classic example of an adverse excursion entry. This is an entry after the fact. So we see that we waited for the market to cross the prevailing trend line in order to get a buy opportunity. From there, we can see that the market continued to push up, and it pushed up into a selling time. We would have ignored the signal completely and really literally done nothing with it. We would have ignored it because, again, it's counter to the trend. So if you're trading with a trend, this type of signal, and this is the way you would engage the market. Moving bar by bar, we can see that based on our knowledge that we now have and based on the patterns, the market has pulled up. We have 3 consecutive higher high buying bars here. So buying bar, buying bar, buying bar, at least 3 into a buying time. Therefore, this meets 2 different patterns. This meets a pattern 5 rule, and it meets the pattern 9 rule, indicating that we should expect to see a small pullback in the market until the next signal, realizing that the next signal is only 2 bars away. The market pulls down, stops dead in its tracks. After a hard run up, the very next signal is a sell. That move would be out. Again, if you only have 2 bars to engage the market, consider seriously whether or not you're actually going to do that. So every time I do a training with someone, and every time we've gone through all these different training sessions over the years, there are some common sense methods to keep in mind. One is, do you have enough time for the trade to play out or to work out? In some markets and some instruments, sure, there's plenty of time because the markets move very quickly. In other markets, such as the S&P here, it tends to take a little bit longer sometimes to get a move going. So again, things you want to consider. When we're watching the market continue up, again, we would have ignored the sell signal, identifying that it is a counter to the trend move. Not a big deal, just waiting it out. And now as we pull into the next buying opportunity, we would have been looking for an opportunity to buy the market. Using the RevPol rules, we would have narrowed this move down into a lower market pivot, and this was only a 1-tick bar, so therefore we could have looked to buy the market long here. By buying the market long, our maximum risk sustained would have been at the dot value, and as soon as the market is closing any kind of a candle in the expected direction, we would be then looking to be locking in profit. So our maximum risk falls just barely below the dot value, and again, this is trading with the trend. As soon as the market closes the first bar above the open price line, at that point we are reducing our risk into the next signal target attained. Again, using a little sense in the ability to watch the markets go through. Now, if you're trading with the trend, that's pretty much the way you're going to engage the market. Use the knowledge that you have and buy the market above the average price, sell the market below the average price, and utilize some of the things that we've learned. One of the common things that I like to do is I like to only buy the market if the market is at a selling candle. And oftentimes in my program, you will see that in a situation like this, I would wait 1 bar. So instead of buying the market at the close, even though it was a really small candle, I would actually wait 1 bar to see, because this was a buying bar, I would wait to see if this bar gives me a sell. If this bar gives me a sell, then the sell within 1 bar of the buy time gives me my better risk opportunity, still looking for the same profit target. So in this case, I would have actually been looking for a move from here, which gives me an additional point in the market. Lower my risk, because I'm entering long on a selling or a down close candle. So those are always things that I want to see in the markets. So if you're trading with the trend, this is the methodology that you want to adopt. You want to be watching for where the market is giving you the lowest risk possible entries. Once again, here we're coming into the same situation where we close a buying bar at a buying time. Not a fan. Wait to see if I can get a lower risk entry, and this one doesn't really give me one. Market continues down, and we're out basically at the same price we got started. Now, if you're using a little more discretion, I want you to pay attention to something in the markets. There are things that you're going to see the longer that you spend time and the longer that you engage with trading time versus trading price, that you're going to be able to use and incorporate in your trade plan or in your trade methodology. A person who trades with the trend, again, you're willing to take that trade and you're looking for opportunities in the direction of the trend. Some of you are going to be trading counter trend. It's the nature of who we are as people. If you're trading counter trend, I highly recommend that you consider the pattern 4s and 5s. There's a pattern 4 or 5 booklet that's going to come along in your download section of the website. Please check out that downloads, because when you're looking at your pattern 4 and 5, if you are a counter trend minded trader, that is going to be your new favorite tool. When you're looking at a pattern 4 or 5, we can see in this particular case, let's put our indicator back on the chart for the swing, keep us on the honest side. And coming down here to swing. And at the time of day that we came into this buy signal, we can see that the market was obviously at a new high. This market met all of the rules that we would commonly observe, and we would be looking for a short off of the close of the candle. Counter trend, counter intuitive. A buy signal that has a singular bar larger than the rest, and then we have the 3 consecutive bars up. On this candle, we met the 5 rule and we met the 9 rule. By meeting both of those rules coming in within 1 bar, we would have been able to sell the market at the close of this candle. We have a 3-bar window to work inside of, again, refer to your handout. And working inside of this 3-bar window, if the market puts in a brand new high, just like our rules earlier, then we can sell the market at the close of the buying bar. And by selling it at the close of the buying bar, we would now be able to place our risk just above the top of the highest point of the candle. So the highest point of the 3-bar window. From there, we sell the market at the close of the candle. Earlier I mentioned, and I reset my platform and didn't get it on there. Earlier I mentioned that one of the tools that you have to have on your chart is a bar timer. And again, the bar timer is what's going to tell you the exact second that you're going to place your order. So as you're seeing the market, this candle would be up, down, up, down, up, down, up, down, doing its thing. We're able to count down to the last few seconds in the bottom right hand corner and identify that this candle falls within our rule, and therefore we are expecting to see a pullback. When I'm using this methodology, I use the dot value now as my profit target. So again, based on the pattern 4 or 5 rule, the dot price becomes the profit target for the counter trend, counter intuitive move. So if you are all into trading pullbacks and trading the counter trend, this is the move you're going to be looking for. One of the methodologies that I like to use is I like to see where the market closes in relationship to the open price line. I want it to get below it fairly quickly. If the market does not close below the open price line inside of the first 2 bars after the 3-bar window, then I start reducing my risk. So in this particular case, I will be pulling my risk down where I had my short entry opportunity at 44.81 and a quarter, at 44.81 and 3/4. After 6 minutes in the market, I now have 2 ticks of risk. So I originally was risking a point, and now I'm only risking a half a point. And I will follow it down until it starts closing below the open price line. Once it gets below the open price line, I would be out of this move here entirely. So again, first profit target is the dot value. Second profit target is the upcoming signal. So here we would have been able to gather a little bit of profit off from the short opportunity. Here we would have been all flat there on number 1. And if the market continued to move down, contract number 2, we would be definitely locking in profit on it. So we're not going to take a loss. And off of number 2, we do end up getting that profit, although it takes it a little while. So here, again, if you're trading 2, you had the entry at the same spot when number 1 was attained. Number 2 goes to a free position. Free position would have been just a couple of ticks of profit. We're not going to let it lock in forever. We would have locked in at least a half a point. And this one ultimately ended up working out as another profitable trade. Again, just taking the dot value and casting that number forward to here, 7 points on number 2. Number 2 was identified by the dot. So that is a typical pattern 5 trade, very similar to what you would see us do in the live room. Again, counter trend, counter intuitive. Some of you in the markets are going to be using things like what you can see. When you're using time, I'm going to scroll to a different spot on the chart just so we have something different to look at. When you're playing with time and when you're using time, we have a tolerance. Everything in life generally has a tolerance. And oftentimes in my machine shop, we have a tolerance of 1/1000th of an inch. So we will be plus or minus 1/1000th of an inch when we're doing a precise cut. Everything has a tolerance. When they build our houses, they have a tolerance of plus or minus 1/16th of an inch for walls being square. Things like that. In time, we also have a tolerance. We have an expectation that the market will generally reverse within 1 bar of the time signal as projected. So when the market is repeating itself, the market will normally give us a common reversal, and that reversal will occur again within 1 bar, the overwhelming majority of the time. When we're looking at this on the chart, that simply means that if you're using any kind of discretion at all, and some of you are smart enough out there to be able to program things to do this for you, if you can see the direction of the market, the most recent 3 to 5 bars. So if we're looking at the hard right-hand side of our chart, we can see as the market is coming into this buy time, the market was indeed pulling down the last 3 bars. So if we can identify the market pulled down for 3 bars into this time frame, not the prettiest thing in the world, but from here the expectation was we should see a move right back up. We would expect to see that reversal or that market pivot occur within a bar. This goes for buys and sells. This goes regardless of trend. If we see the market giving us a push higher, and if we can identify the market pushing up within 1 bar, which could be the bar before the signal, the bar of the signal, or the bar after the signal, if you're trading with discretion, this becomes a place where you can fade the market. Here we see the market coming into a sell, very counter to the trend, and we are expecting at least a short-term reversal. This one takes at least the last bar, so it takes 1 extra bar there. Again, the reversal came in within 1 bar. You can actually go through and draw a box around each of your timing signals and watch for the market to start moving back inside of this very narrow window of time on the majority of the signals. So you should expect to see a pullback occur almost every time for at least a short duration. This goes the same for buys and for sells. If we see the market pushing up into the 406, realizing that there's only 2 bars into the 412, we should expect to see somewhere at the shared bar here, which is the 409 signal, we should start expecting to see the market to give us a small pullback. The market indeed tries to give a pullback, doesn't give a whole lot of leverage, and ends up pushing a little bit lower. So again, off of each of your signals, if you can clearly see the direction of the market coming into a time signal, then watch for a reversal off the other side. Oftentimes, the reversal may take a few bars, depending on the time of day, but again, from each signal that we're seeing, we should have an expectation that this market should push down if we can see the push up. Okay, so as you're going through your chart and if you're applying some discretion, look for opportunities where the market is clearly showing the reversal. If the market is not showing the reversal clearly, in other words, if we're seeing a very choppy area and we can't readily identify what has happened the most recent 3 to 5 bars, then take the bar or it's a signal at face value. It's a buy time. Watch for the push back up. So again, at each of the signals, we should have an expectation that the market will reverse within a bar. So off of each signal, again, we don't know how many pips, points, or pennies the market is likely to move, but we do know that the market is most likely going to stop and turn at each of the signals. So if you're trading with discretion, that is a great way for you to approach trading with time. Again, with the time, we know ahead of time that each of the signals, we know when they're coming. They are already on our charts when we get started every day. So when we set our back spacing to be able to see the future, again, watch for opportunities as they occur. Regardless of buy, regardless of sell, regardless of the color of the signal, we should have an expectation that the market will stop on time, every time, and watch for a short-term reversal. In the overwhelming majority, this one did not work. But this one did not work out of how many that did. So out of each of the signals that we're watching for, you should expect to see a market reversal occur. And off of each of these reversals, again, if you can't tell the direction, take it at face value. So the signals, if you're trading with discretion, will oftentimes give you very nice moves, but you have to see them coming. So you have the ability with the indicator to trade counter trend, trade with the trend, and trade discretion. And all three of those methodologies are all valid depending on your individual personality type and your individual preferences for the markets. Make sure whatever you're doing in the market, make sure with everything that you're doing on your time cycles that you're doing back testing before you place live money on a trade. And in everything, make sure that you observe the golden rule of trading. Preserve precious capital. Thank you again for attending our small series based on your TimeWarp indicator. If you have any questions or comments, do not hesitate to let us know. Thank you.